Hello, everyone. Each month, I bring you the latest San Antonio market trends from the previous month to keep you informed and ahead of the curve. This year, we're at the end of the year. Merry Christmas. It's December. And I'm joined by my trusted lending partner, Jen Bailey with Legacy Mutual Mortgage, so you can get a clear, up-to-date insight on real estate and lending to help you make confident decisions. I'm Missy Stagers, broker owner of MStagersRealtyPartners, and this December market update for San Antonio and the surrounding area is as follows. As we close out the year, the San Antonio housing market is operating in a balanced market locally, that's the San Antonioan, while the broader San Antonio New Braunfels MSA area is buyer leaning. San Antonio is currently at a 5.9 months worth of inventory, which means it's pretty much buyer-seller, give and take, while the metro area is closer to 8.9 months, reflecting a higher supply in the outlying areas. That means buyers are really driving that market. November recorded 2,206 closed sales, down year over year, which speaks to a slower market. Despite lower transaction volume, pricing has remained resilient, which is always interesting. The median price rose by 5% year over year to $315,000. The average price increased $374,831, showing that sellers who are priced correctly are still closing successfully. Personally, median price, I think, has been impacted by new home sales prices being in our mix of numbers. However, market leverage continues to shift. Homes are averaging 86 days on market and closing at 92.4% of the original list price, indicating stronger buyer negotiation and an increased role of concessions. An example of that is a $500K home at 92% sales price is $38,000 decrease, which in turn means the home was probably overpriced. Inventory remains the primary driver of these conditions. Active listings climbed to over 16,100 homes, up 14% year over year, while new listings declined seasonally. Supply and demand imbalance continues to favor buyers heading into the new year, and we're actually at about 2013 levels for the amount of homes for sale. From an economic standpoint, San Antonio still remains stable. The metro added more than 47,000 residents over the past year, and unemployment is holding near 3.8%, continuing to support long-term housing demand despite affordability pressures. At the state level, Texas is seeing elevated inventory and a modest price softening, including San Antonio, as we know. This confirms a market that is adjusting rather than contracting, with activity sustained but pricing power redistributed. For sellers, the data is clear. Pricing accuracy and presentation are essential. Homes that miss the market tend to sit longer and require larger concessions to secure that buyer. For buyers, increased inventory creates leverage for you and a lot more choice. Negotiation on price, terms, closing costs remains strongest in higher supply segments and new construction that has had a lot of competition. Builders continue to use incentives effectively, keeping new construction very competitive as buyers prioritize monthly payment strategy and value over resale. January outlook. Leading indicators looking ahead to January suggest a continued buyer's market, not a market reversal. So sellers still got to go through some pains. Pending activity remains steady. Inventory levels are expected to stay elevated, and the days on market are unlikely to compress anytime in the near future. Pricing is expected to remain stable but selective. Well-positioned homes should continue to sell, while overpriced listings may face more than just longer times on market and further adjustments. Broad price appreciation is unlikely in the short term, but localized opportunities will depend on supply levels and buyer demand within each segment of the city, because every zip code is different. Economically, population growth and low unemployment continue to provide us this solid foundation for housing demand, helping limit the downside risk that recalibrates the market. We don't want a 2008 or a 2009. As we move into 2026, this remains a market driven by strategy, great data, timing, and also having all those things lined up correctly. Now I'm going to hand it over to Jen Bailey with Legacy Mutual Mortgage for the latest updates on rates and lending trends.
Hi, I'm Jen Bailey with the Unity Group of Legacy Mutual Mortgage. Let's talk about where rates are at. So conventional's right around 6.3 and FHA and VA right around 5.9% right now. The Fed did just cut rates by 25 basis points for the third consecutive meeting with a vote of 9-3. Now, one of the Fed members voted for a 50 basis points cut and two others voted for a pause. But also in good news, the Fed announced it will start buying $40 billion in Treasury bills starting on Friday. Also, MBA released their mortgage application report for the last week, showing that rates remain stable around 6.33%. But we are still 40 basis points lower than this exact time last year. So that's the good news this year compared to last year. Now, purchase volume did fall 2%. However, we're still up 19% year over year. So right now, compared to a year ago, we're up 19%. And refinances did jump up 14%, and we're up overall 88% year over year on refinances. Now, the Fed's next meeting is January 28th, and the market is only pricing in a 22% chance of them doing a rate cut at that meeting, so most likely there will be no rate cut at the next meeting in January. However, let's talk about 2026. In terms of 2026, the dot plot projections of rate cuts point to maybe only one more cut next year. We shall see, but that's down from the previous expectations that there would be more cuts. That just shows that there's some internal disagreement between the Fed members right now on what to do next year. But the biggest thing to keep in mind is that the Fed controls short-term rates, not directly 30-year mortgage rates. Now, mortgage rates are driven more by the 10-year Treasury and market expectations, which don't always move in lockstep with the Fed actions. Now, this means that even if the Fed doesn't cut much or at all in 2026, mortgage rates can still improve on other factors. There are so many different factors that go into mortgage rates that they are based off of. So we shall see. Now, it does appear that the Fed's going to be a bit dovish next year, which is typically good for interest rates. So I will keep you posted.
Thank you, Jen, for staying informed is the key to making decisions. If you'd like a personalized evaluation of what to see, how ready you are to take a move, check out our quiz. It's in the link below. Thank you for joining me. I'm Missy Stegers, MStagersRealtyPartners, Realty Partners, and we look forward to bringing you the market report next year with hopefully a little more information, but most importantly, Merry Christmas.